This is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 28th of 2023. Please share a disclaimer for important information. Starting out this week, I want to address some dislocations that we're seeing in the market right now. Obviously, the S&P 500, if you look at it on its face, seems to be doing pretty well, right? You feel pretty good about things. You're kind of like scratching your head and like, well, what about all this and recession talk and all that? We have a really odd thing going on in the market. We want to spend a little bit of time talking about it. We've got some economic data a little bit later on in the chart pack and some other things that I thought were interesting going through the weekly research this week. And first we have here the difference between dividend paying stocks and the rest of the S&P 500. And so as you all know, dividend paying stocks were very resilient in the face of an awful market last year. Quality and dividend paying stocks were the two factors that really outperformed last year. And we were proud to say that we were allocated in that direction. But so far this year, it's been a bit of a different story. Again, we're sitting on the precipice of what is very widely expected to be a recession. We've got a lot of indicators that are pointing that way, not the least of which is the index of leading economic indicators, which has tremendous forecasting power historically in forecasting and foreshadowing recessions, I should say. However, the market is really not buying it right now. And we see here on the left-hand side, if you take the dividend paying ETF performance on a total return basis and you subtract it out year to date, what you subtract from that year to date, the performance of the broader S&P 500, you see a massive divergence there. And you see that really kind of articulated maybe a little bit more visually on the right because you've got directionally the total return of the S&P 500 ETF overall in the blue, and in the pink you've got the dividend ETF, those that fit that factor within the S&P 500. And you can see this deviation is rather dramatic. I mean, these charts say the same thing, but the gap in performance thus far this year has been 12 percentage points, which is extremely, extremely rare, and especially for this time in our economic cycle. So we want to delve into that a little bit more. Well, another thing we want to talk about with regard to the S&P 500 is the market breadth, and we just don't have that right now. And what does that mean? That just means that a very, very select few stocks are driving the boat, so to speak. And we see here in this chart, going back to 2007, that the percent of stocks outperforming the broader index is at an extremely low point. It's 28% right now, which is very anemic. So again, we have a handful of stocks that are influencing the entire market when the rest of the market is really not reacting well. The rest of the market, frankly, is acting as if we're on the edge of a recession. But you wouldn't know that if you're looking at the index because you have the influence of Apple, Nvidia, Microsoft, and Google, which is Alphabet. So, it's a little bit distorting here, and you've got to go back on this particular data series here. You've got to go back to the tech bubble in the late 90s to find an environment quite like this. Of course, you go back to 2020, you see that number is 36%. So just think about that. We had an economic shutdown, and then we reopened, and then everyone ordered on Amazon, and everybody ordered stuff to be delivered. So there was a lot of service-oriented firms, even a lot of manufacturing firms were shut down, but people were ordering stuff to their door. And so again, a very limited subset of companies outperformed, and the rest of the market just kind of slogged along. And that's exactly what is going on right now. And in this chart, I'm going to drive that point home here because we've got the S&P on the S&P 500, the weighting of the top two holdings. And here we have Apple and Microsoft that represent 14.1% of the overall index. Think about that. We've got 503, I know that's an ironic number, but 503 constituent companies in the S&P 500, and 2 of them account for 14%, and the top 5 account for over 25%. So you've got 5 companies accounting for 25%, and the other 75% of the index is accounted for by 497 companies. So again, in a capitalization weighted index, you have an amazing influence by a very, very select few stocks. And you can see in this time series, it goes back to 1980. Just think back, the blue chips, you had IBM, back Microsoft in the tech bubble led, and then you had Exxon back in the mid 2000s before the tech bubble and during the tech bubble. But we haven't seen something like this in a very, very long time. Here we'll look at NVIDIA. This is the market darling right now. It's up, 170% almost, and but this really underscores the issue in the market. Not only do we have very, very limited breadth and participation, that being that only a few stocks are really, really doing well, and the rest of the market is just slogging along. Well, not only that, but you've got the stocks that are doing extremely well are extremely overvalued. And let's look at NVIDIA here. You got price to sales ratio, 29.4 times, and then go back to the tech bubble. You had October 2000. Again, this is on the precipice of that really tough period after the tech bubble burst. We're at those levels right now. You look at price to earnings ratio. NVIDIA is trading at 182 times earnings. And you can see how that fares. So you got to go back to the tech bubble to see those kinds of multiples that we're at now. Now let's talk about the difference between the S&P 500 index that we all see quoted in the market, in the financial press, and on CNBC, et cetera, and what we call the equal weighted S&P 500. And this distinction is really important. So I just got through talking about how literally 5 stocks account for about 25% of the index. So the S&P 500 that you see quoted is called a capitalization weighted index. And so the large firms obviously have a very outsized influence, and they represent a huge part of the index, just as we've been talking. Now, you compare that against the equal weighted index, same constituent firms, same 503 companies in the index, but instead of weighting them by the size of the firm, they're weighted equally. And so you tend to see deviations from time to time in the performance of those. And right now we just looked at NVIDIA. I mean, hugely overvalued right now, but it's the market darling. Everybody wanted to own it, and there's probably retail investors that are jumping on the bandwagon, perhaps a little bit late, buying a very, very expensive stock. But you can see here over time on the left, and I thought this did a wonderful job of setting up what I wanted to talk about here. So we have the biggest outperformance by the overall S&P 500 index over the equal weighted index. So we've had the biggest outperformance since 1999. Well, guess what happened in 1999? That was our tech bubble. Same deal going on back then. Technology stocks were the high flyers. A lot of the cyclical stocks were kind of a little bit tired. You could tell we were towards the end of an economic cycle. They just weren't performing very well. We've got the same deal going on right now. And so on the right-hand side, you've got basically the relative returns on kind of a diffusion index here, if you will. And you can see here where we are now in terms of this outperformance. I mean, we're more than 2 standard deviations from the norm. And what does that mean? Statistically, over 2 standard deviations represents essentially, there's only like a 4 in 100 chance of having this happen. So we're in really rare territory here, and it's very odd too. Now going back over the left chart, I want to point this out because there is usually a mean reversion to this. And when you look at this, we've had the biggest outperformance since 1999 in the overall S&P 500 versus the equal weight. But go back to 1999. Look what happened after that. We had several years of a correction. This is after the tech bubble burst, and we had a very difficult market. But then the overall S&P greatly underperformed the equal weight. And so when you think about this, if you think that you're on the precipice of a recession, you want to right size your portfolio to the factors that tend to outperform in a recession, that being dividend growth, capital strength. Those are companies that are very much better represented right now in the equal weighted index. And so, what I'm telling you is that, these stocks like Nvidia that have very rich multiples, they tend to mean revert. And you can see periods here where, you do get outperformance by the broader S&P 500, but that tends to be followed at some juncture by a reversal in that, where the equal weight outperforms the capitalization weighted market index, and that is apt to happen here once these high flyers kind of lose steam and then get sold off. Now we're going to continue this theme of the so-called high flyers, if you will. This is the NASDAQ 100 stock index divided by the Russell 2000, which is much more representative of small caps. And we know right now that small caps are really struggling, certainly not only on an aggregate basis, but also relative to the large company index. And that's pointed out here. Again, you got to go back to the tech bubble to see levels that we're seeing here in terms of this relative outperformance. So now let's talk about earnings and profit margins. And so, coming out of this earnings season, there are a couple things that we can certainly take note of. One is actually kind of an oddly positive observation, is that earnings were better than expected. Earnings were, reasonably well received and obviously better than expected. You can see that on the left-hand side. And the other thing that happened was operating profit margins were a little bit better than expected. You can see that uptick to 11.8%. That was not anticipated. We were expecting margin erosion, but what's happening here is we have pockets of pricing power where producers, distributors, et cetera, are extracting additional pricing power relative to their cost structure, and margins are going up a little bit. Now, at some point, that's self-limiting because people catch on, then you have price discovery, and then competition kicks in, and then you don't have these kinds of things happen. Particularly in a recession, you'll see prices drop, and you'll see margins, you'll see just general operating profits slide lower in that environment. Well, here we have the Russell 2000 ETF over the S&P 500 return. So again, just showing you that small caps are underperforming relative to large caps. Another definite highlight of that. Here we have the Russell 1000 value over the Russell 1000 growth. So this is another factor-based analysis here that I think is important. So right now, I mean, you see that, basically value is underperforming growth this year, but you can see that value has been pretty strong for a while. And then with, some deviations here, we see, growth outperform, but, last year, value was very much in the driver's seat. This year, not so much. Here we've got the NASDAQ 100 median price to sales ratio is picked up. Oddly enough, it's not out of line, but the earnings are out of line. Again, these are the large companies. So where sales based multiples are not terribly out of line, the earnings based multiples are completely out of line right now. Here we'll transition into some economic data. We've got durable goods orders month over month. You can see here in the yellow shaded, the estimate was for a slight decline, and we actually got a positive read. So here we are at the precipice of recession, having an unexpected uptick in durable goods orders on a month-to-month basis. again, not something that you would expect. It's got this market in a bit of a quandary here, trying to figure out amidst all of this very seemingly confirming data, like in the LEI and then production and manufacturing data. Certainly, we're already in a global manufacturing kind of recession, if you will. But this kind of data really belies that, and of course, it can be volatile month over month. And I do think it is not habit forming, as we'll see in the next chart. So here we have capital goods orders on the in the black year over year on the left hand, utilizing the left hand scale here, and you can see that those have kind of petered out, and then you have corporate profits that are in the orange here that are on a 6-month lag. So you got orders first, and then you've got the profits that are kicking in after that. And when you do that 6-month lag, you can see how nicely this chart lays, these two data series lay on top of each other. And so this is another one of those really strong, presupposing type data series that tells you that you've got profits that are decelerating that should lead to less spending. And when you're in a cyclical downturn, those things get to be self-confirming, right? Because you spend less, and then that leads to further declines in profits, which leads to further declines in spending, and it gets self-confirming until you finally have this capitulation where everything kind of washes out, and then you start to reestablish a new market cycle. Here we have the University of Michigan Consumer Sentiment Index. So this is different from the consumer confidence number, and as we've talked about in the past, this tends to be much more influenced by the perceptions of inflation. So, for a while we had the sentiment number that really cratered, and we could see this last year for sure. And you can see that really deep dip there in 2022 as we had really strong inflation. Well, that number improved, but now it's moving back the opposite way. And you can see the red line here draws this parallel. And Charlie Bolello does a wonderful job of kind of like these historical kind of vignettes, if you will. So you got to go back to 73, 75 recession, and then you see these other areas that were where the number has reached this level, and you go back to the recession in 1980, and then the 08-09 global financial crisis. So this is while we have the durable goods orders that was the order that was better than expected, we've got this sentiment index, which overlays, extremely well with historical recession periods. So, all of these things need to be taken in a mosaic and not in isolation. Here we have some inflation data. We've got on the left-hand side, we've got core PCE, personal consumption expenditures inflation. So the estimate was looking for about 0.3. And for the monthly data, and then we actually got a little bit higher inflation. You can see that in the red. That was not expected. So you've got some data, again, showing slowdowns. You got some data showing, a really strong economy. Then you got this labor market that's kind of in flux right now, but it's still kind of holding in there. But then, you look at the core PCE inflation in the lower left, and it's just kind of like stuck in like second gear here. So, it was a little bit higher than expected, about 4.7. PCE inflation typically runs a little bit below CPI inflation, which we have talked about, very, very recently. Now, if you back out housing, which is the stuff on the right here, you can see that it is absolutely sticky. And you can see it's almost flatlining, if not maybe slightly moving higher. So this is something that is really confounding to the Fed. They're at a point where I think there is consensus for them to kind of wait and hit a brief pause or maybe skip a meeting. But then there's other data that even amidst this debt ceiling crisis, which as of today and as of this recording, the potential deal has passed a key hurdle in the House, which was the committee vote to send it to the broader floor, the Rules Committee, and that did pass that vote. So it looks like we're going to get a deal there. But aside from that, we just see, you know, enough impetus for the Fed to perhaps have a reason to raise rates, but also a reason to pause. Well, here we have PCE expenditures. So this is actually the spending component to the complement on the spending side to the inflation data that we just looked at. And so in both cases, again, going to my point on the last slide, that there's equal, I shouldn't say equal, but there's a lot of data that paints a positive picture that if you're a Fed voting member of the Federal Open Market Committee, you would be inclined to want to vote for another 25 basis point rate increase. This would be one of those data points that you would use to justify your decision. So we have expenditures that were better than expected, and also on a real side, if you back out the inflation component of it. So strong data from consumption, but I don't want to get too carried away because, as we'll see, we've got credit card balances that are going through the roof right now. So with all of this going on, to my point of, it's beginning to influence people to think, well, maybe we'll get another 25 basis point or quarter percentage point increase in interest rates, and that was, you wouldn't have even begun to think about that like a month ago. So you see here on the left-hand side, you have the difference in the amber line. You've got the implied changes in the overnight, i.e. short-term interest rates, as of the 15th of May. And in the blue, that represents the data as of literally the end of last week. And you can see here very clearly, market now having a greater expectation for an interest rate increase, not only for June, but also July, which is really remarkable. Again, it's they're looking for perhaps a modest change. But then you get these declines later on in the year. Again, we've known this for a while. The market is pricing in, rate drops of some degree by the end of the year. Well, the estimated drops that were being priced into the market literally 2 weeks ago have really kind of dried up a lot, and you can see that on the right-hand side of the left chart. Now, on the right-hand chart, you see the futures curve, and so this is the market pricing in what they think interest rates, short-term interest rates, are going to look like. And you can clearly see that the blue line, which is the current number, is definitely above where it was literally just 1 week ago. So more interest rates increases are expected, and a longer delay in the eventual rate decreases. Well, here we have some evidence here. Again, another couple of data series that just really lay on top of each other. Again, we've got the National Federation of Independent Business, NFIB, corporate price plan. So these are surveys of NFIB small business members. And you can see that a high degree of those are saying that their pricing power is eroding. You can see in that amber line rolling over. Well, that's data that's advanced 6 months, and you can see the core PCE deflator, which is really kind of a measure of inflation, and that's lagged behind this corporate price plans. You see how it lays over, and with this in tow, you really would feel a lot stronger that inflation is going to decelerate in the coming months, and that would be a reason, kind of in light of the last couple of charts. This would be a reason right here to say, you know what, I think let's pause. We've got the setup really nicely for inflation to subside, and so why wouldn't we want to wait? So this is kind of like a chart that kind of shows the other side of that argument a little bit. Well, real quick look at some, consumption-related information. We got the personal savings rate, which is still pretty low, upticked slightly in the last couple of readings, but still very, very low. And as it shows here, we topped the lowest point since 2005. Obviously, stimulus money is gone. And you see on the right-hand side, kind of what's holding us up on consumption right now is the year-over-year increase in credit card balances, which, as you can see here, has very much accelerated in a very short period of time. So looking at the mortgage and the residential housing side of things, I thought this was very interesting. You still have a lot of mortgages that are at pretty low rates, right? You've got most of which are 30-year fixed rate loans, have an interest rate below 4%. You can see in this kind of a histogram right here how that lays out. So, this is a big disincentive, right? If you've got a home that you like, maybe you're working from home a little bit more and you got a low rate below 4%, what's your incentive to want to relocate someplace else just so you have the privilege of taking on about a 6.5% mortgage rate? And so I think this chart right here shows you that, with all of the folks that have been forced to move for job reasons or whatever, that are taking on those higher notes, there's still a lot of people with these low interest rate mortgages. All right, so let's look at housing payments. So, you look at consumption, we talked about credit card balances going up, but personal consumption expenditures still remaining pretty strong. Well, here's something else that's going to take a bite out of that eventually. And you can see housing payments are up 9.5% year over year. I mean, obviously, this is the most expensive thing that most households have to deal with on a monthly basis is their home payment, then cars, and then blah, 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 blah. But, you've got these payments moving higher. It's going to curb spending at some point. And I think it's a real data point. You look at this compared with prior years and you look at, 2020 and how much this has changed. I mean, the delta obviously between 2020 and today is dramatic. I mean, 9.5% year over year is bad enough, but when you look at it, based on that, I mean, you're looking at 40% in a multi-year period. This is pretty outstanding. So, when we talk about housing costs and owner's equivalent rent, we've got some data from Redfin here. So this is the rent growth data from Redfin. So we've had 11 straight months of declining growth in rents. And so you think about, what rents are important to, well, it's certainly core CPI and CPI to some extent. So when you start thinking about decelerating rents, I mean, which typically follow home price declines, which we know that we've seen, so this is entirely natural, especially if you're heading into an economic downturn. You certainly expect decelerating rents, which, again, as a 40% of the core CPI figure, if you have decelerating rents, that's obviously going to help your inflation picture. Well, on the other side of the coin, we've got expansion capital and the cost of that and the ability to get it. So as you see here, this is the percentage of banks reporting tightening in their lending standards. So, we had Silicon Valley Bank and those genre stress in the regional bank sector. Well, that caused banks to kind of pucker up a little bit and it decreased their willingness to make loans. So they got tighter on credit. Well, you can see that picking up again here very clearly. Now, it's not just like at a point where we've seen during recessions, but it's directionally, it's very much moving in that territory. You can see going back to 1990, 2001, you got the 08-09 global financial crisis, and then the pandemic shutdown there. And we're getting up into these areas. And again, so we talk about all these different little data points that, these peaks or these inflection points tend to line up well with recessions. This is one of them. And it should be very intuitive to all of you. When you have banks that are tightening credit, small businesses, medium-sized businesses can't get expansion capital. They can't roll over their loans. They're kind of stuck. You've got expansion projects that are like stuck because you can't get financing or you can't even start the projects. So you stop spending, you stop do capital budgeting, your capital expenditures go down, and so it's a self-fulfilling prophecy. If you can't get credit and we're not expanding credit, that the economy is naturally going to slow down. Going to pivot a little bit and talk about the government. Obviously, we've mentioned here that we have got the budget, the debt ceiling legislation that passed the Rules Committee. So we expect tomorrow being Wednesday, that we'll get a full vote on the floor of the House, and then that will go on to the Senate. But here we see, the pace of the federal budget deficit, and so we've taken a turn for the worse. This is something that the Republicans are looking at. They're wanting to curb spending, and so there's a little bit of that compromise in the bill. You can see how that's played out. So deficits have exacerbated, and at the same time, as we've talked about in previous weeks, that federal tax receipts have also gone down lately. All right, so as we look out on the horizon with the bill that is being voted on this week, you've got the Congressional Budget Office, the CBO baseline forecast, and that dotted green moving ahead from here. This is authorized discretionary spending at the federal level. And then you've got the White House proposal, which, was kind of a mirror image, a parallel image to that. And then, of course, you've got the House Republican bill, which is a major deceleration in near-term spending over several years. And the compromise is really somewhere in the middle of all of that. But you can see here that discretionary spending under really any scenario is apt to go up over time. So interest expense, this is something else that we're going to be paying a lot of attention to in the coming years. Is if you look at in billions of dollars over the trailing 12 months, through April here, you can see that, as interest rates move higher, the cost of debt service for the federal debt goes up as well. We'll talk about commodities, which we've seen a pretty strong turnaround here. We've got corn in the green, wheat in the red. We've got eggs at the market. It wasn't too long ago that we were having this long conversation about how expensive eggs were at the supermarket. Well, you see directionally, all of these have moved much slower in a pretty relatively short period of time. So these commodities are not nearly as onerous as they have been. Here we have fertilizer prices. And again, you think about what went on last year. We had the Ukrainian invasion by Russia, and Russia is a big, not only a user, but a producer of fertilizers, and so especially potash. And so these fertilizer prices went nuts. Now they've come back down, and they're at their lowest point since 2021. So we basically have almost retraced all of this gain that we've seen. So again, more commodity price relief overall in the chain, which, if we tie back to profit margins that we talked about earlier that were oddly above expectations, this would be a reason why. Input costs, your commodity costs like corn, we saw that in the last slide. These prices going down have a beneficial impact on cost structure for a lot of the producers where these things are the inputs to. All right, a little bit more demographic information, and this one really caught my attention. So, we talk about the younger generation, and I think we talk a lot about like these millennials being kind of persnickety employees, but when you get down to the teenage level, again, that's the you've got the millennials, you've got the Gen Zs, and then you've got this teenage generation, which is kind of like Gen Z, but it's like foreshadowing that even next evolution. Well, looking at it here, you can see that we've had a dramatic improvement in the labor market for these 16 to 19-year-olds. And again, these are the people that are going to be entering the prime working age here in the next 5 to 7 years. Again, on the demographic front, what's interesting here, and this is out of Wall Street Journal, but going back to the middle of the first decade of the year, we kind of peaked at on our birth rate, and so we've been in deceleration ever since. At the same time, obviously, you're trying to keep the kind of this lavender line, if you will, this kind of reddish, pinkish line here above the gray line, which represents deaths, but that gap has narrowed quite a bit. So obviously we had a little hook there with COVID, and now that's moving down, but the gap has very much narrowed, and so you're not replacing people that are dying with new births. And so demographically, if you're an economist and you look out over the next 25 years, this is pretty damn important because you're going to have a situation where you're not replacing your most productive workers that are heading towards retirement or dying off, so yeah, I think not to wax too political. This is going to put some pressure on some immigration policy reform. Again, that's bipartisan, so I'm not speaking in terms of any political view here, but clearly, if you've got a deceleration of the birth rate and the net birth rate, you've got to do something about that to maintain the productivity of your workforce. Here we've got something, another something I thought was pretty interesting. A lot of interesting stuff this week. So, left-hand side, share of people who said they were not going to travel. Basically, you can see that going down. So, again, if the article, and this is all in the Wall Street Journal, the thesis was if you're on the edge of a recession, people are worried about stuff, right? They're worried about what's going to happen. They're going to not travel as much. They're going to hold their chips closer to the vest. Well, I'm here to tell you that really ain't happening. You can tell that very clear on the left-hand side. And then gasoline prices, as it relates to the summer driving season, you can see how that's evolved. We had that spike. Prices came down. They ebbed up a little bit, but they seem to be kind of holding in there. Again, you typically see a little bit of a summer bump just because there's increased demand for driving. But, again, it's not like it was last year and a little bit like it was a couple of years ago. But, prices overall, looking at supplies and stocks are apt to kind of hold in this somewhere in this 350 gallon range. So, another thing that we're going to be talking about, and I'm going to spend some time really thinking about this, is, what's going on in China, right? I mean, the big competitive threat, a lot of hot air out there now. China reopened after the pandemic. And ironically, they're getting ready to enter a whole new wave of COVID. I mean, that's like yesterday's news here, but China is bracing for another round of COVID, right? Because of all the things that they didn't do that they should have done. And so this kind of resurgence coming out of this COVID lockdown, I think, is in the process of kind of petering out. And that's important because that may signal some slowing of growth in the emerging market sector. You can see here the credit being provided to the non-financial or the public sector here, or excuse me, not the public, the private sector, is really going up in China when we see all these lender surveys constricting credit everywhere else. So China's trying to artificially prop up its economy that's kind of petering out with a lot of extra credit, expansion credit. And I think that is something that could very well backfire on China. So our last chart of the day, we'll focus on Germany. You can see this line, on its face, it may not seem too catastrophic, which it really isn't. But again, this may be a foreshadowing of what we're to expect here in this country. So basically, we've got German GDP that's now in a recession. You see at the right-hand side, you've got a couple of quarters of consistent rolling over where we've had some negative GDP growth. And, I think this chart is, when we get to the U.S. side of things, it will eventually look very similar. Now, no one's panicking in China and Germany right now, but you can clearly see it heading into an economic slowdown. And if we manage things okay, and the Fed doesn't get too carried away and raise interest rates too much, too soon, without taking stock of the deceleration of the money supply and all these other things that we've been talking about, we can have a hard landing. But if they can avoid that, I think we'll be in much better shape, and we'll have something that we can absolutely weather and then come out much stronger on the back end. Well, that's all we have for this week. Hope you've enjoyed the chart pack. Have a wonderful week, and we will talk to you again soon.